So where does it take things in general? Well, now here's a wonderful quote. And the source of this quote is Fannie Mae, who is extolling the virtues of an organization whom we've all come to know and love, Countrywide Finance. Who knows what, did everybody know what Countrywide Finance is? Countrywide Finance was the first one to go down, yeah, big time, go down, yeah, big time, of the mortgage lenders. So Countrywide tends to follow the most flexible underwriting criteria permitted under GSE. GSE is a buzzword for government-sponsored enterprises and Federal Housing Authority guidelines. Because Fannie Mae and Freddie Mac tend to give their best lenders access to the most flexible underwriting criteria. Countrywide benefits from its status as one of the largest originators of mortgage loans and one of the largest participants in the GSE programs. And who are we when we talk about GSE programs, think 68% of all of the syndicated mortgage, all of the mortgage junk that got produced. When necessary, in cases where applicants have no established credit history, for example, Countrywide uses non-traditional credit, a practice now accepted by the GSEs. So what's the result? Underwriting standards, which had been the central feature of mortgage lending, were gradually abandoned by lenders. High loan-to-value mortgages became more prevalent as piggybacking broadened. No documentation mortgages, usually reserved for high down payment, good credits who paid a high interest rate, became more common, and high obligation ratio mortgage became more prevalent. In fact, they became the mortgage of choice for most of these people. So the old logic, ladies and gentlemen, the old logic behind mortgages is that mortgages are backed by the housing asset prices, right? There's something real behind these things. Down payment ratios cushion lenders against default if prices fall and keep the owners paying the mortgage. Therefore, income streams from mortgages are secure, stable, and reliable. Therefore, the income stream from a package of mortgages can be packaged as an asset-backed security, and if pooled, are actually more secure than the individual mortgages themselves. Now, this is the logic because there was something real behind these things. Now, here's a Bear Stearns promo for securitized mortgages. It's wonderful things you find if you go out looking around. You need to read this because this is a piece of wonderful thinking. CRA-backed securities are attractive to mortgage investors because of their very stable prepayment behavior. That is to say, if you have somebody who's totally committed at the upper end of let's not go into all the detail. Anyway, because prepayments are unlikely to accelerate, the logic behind this is spelled out in the Bear Stearns brochure, but I don't have time. Because prepayments are unlikely to accelerate if interest rates decline, these securities consistently outperform their traditional mortgage-backed counterparts on a total rate of return basis. Now, do you see something insidious happening here? These are the weakest mortgages, should be the weakest mortgages in any given portfolio, but they're in fact performing better because why? Because there's not as much prepayment. So there's not as many adjustments that have to be made as you go along. The RIP is not a footnote, it's rest in peace, Bear Stearns. Now, what's the Achilles heel of all of this project? For securitized mortgage pools, the crucial feature is the mortgage payment, that the mortgage payments continue. In other words, while they are called asset-backed securities, they are really mortgagor-backed. You see the difference? Everybody's thinking, it's the assets that are behind this thing. Not the assets. If once you pool these things, the assets are almost immaterial. What's important is that the income stream keep coming. And if the income stream stops, you got trouble. Because it's going to take so long to get that asset, even under the best conditions, that you're not going to be in the game, if it happens in a big way. So what they depend upon is the mortgagor making the payment. The decline in underwriting standards designed to admit more people to the mortgage market unleashed a flood of unreliable mortgagors into the worldwide securitization pool, and their inevitable departure crashed the system. Now that's the short story. Well, now why didn't the rating agencies drop their ratings on securitized high loan-to-value mortgage ratios? Well, here's a story. You may have missed it in the Wall Street Journal. an interview with Michael Stock. Data provided by lenders showed that loans with piggybacks performed like standard mortgages. The finding was unexpected, wrote S&P credit analyst Michael Stock in a year 2000 research note. He nonetheless concluded the loans weren't necessarily very risky. That was what led S&P to give these things a AAA rating. Now, what was the flaw? Well, the flaw was that the data that he was looking at were pre-2000 high-ratio mortgages, and those were only given in that period, most of that period, because it took a while for this 1992 handbook to get around and to become the accepted pattern. Usually it was only given to high-income earners with exceptional credit scores and high future income prospects. So, by 2006, S&P was making its own study of such loan performance. It singled out 639,941 loans. I think we'll all agree that that's an acceptable sample size. That's 639,000 loans, to see if its benign assumptions had held up. They hadn't. Loans with piggybacking were 43% more likely to default than other loans, S&P found. Some surprise. Now we have to delve into it. So we've looked at why the suppliers were supplying them, but why were the demanders demanding them? Why did all these institutions buy this junk? Well, apart from the fact that S&P said they were AAA. I mean, why did they, what was it about the regulatory structure on the demand side? And now we need to look into that. Before the Boston Fed and the Congress set out to reform banking loans, mortgages were sound investments. Risk-wise, 100% of a business loan had to be reserved against. In mortgages, only 50%. Pooled mortgages or securitized mortgages had a risk rating lower than 50% because the risk was diversified. So what are we saying here? Because ultimately where we're going with this story is, how did all the banks end up being undercapitalized, right? Not having enough capital to cover their obligations. Well, if you've got it in your head that a mortgage is only half as risky as a business loan, and you're reserving, you got to reserve 8% of your capital against each of the kinds of mortgages. If you can load a bunch of mortgages on your balance sheet, what happens to your reserve requirement? It goes down. And what does that translate into, by the way, in terms of leveraging? Gearing, as they call it. It means you're gearing up. So if you can get more of this stuff on your balance sheet, you're going to be in great shape. Pooled, and because, of course, now when mortgages were found to be toxic, banks, the holders were undercapitalized. Now, then the question is, how did it get globalized? It got globalized because of something called the Basel Accords, the International Coordination of Risk Standards. I'm going to give you here a little report which was made by the president of the European Mortgage Federation. He was writing to tell everybody about what the wonderful things that were happening at these Basel discussions, which came into force in 2004, but of course it had been beaten around for quite a few years before that, because Basel I was getting kind of tired and they needed some more reasons to go and have good meals in Switzerland, so they came up with Basel II. The major and most apparent change for the mortgage sector will be a drop in capital weightings for mortgages from 50% at present to 35% under the new standardized approach. This could fall as low as 17% under the more advanced model approaches, which required banks to make their own estimates. This should continue to contribute to big falls in the amount of capital required in this sector. The mortgage sector is likely to benefit under the new rules, which in our view is simply a reflection of the low-risk nature of lending secured by real estate collateral. So, ladies and gentlemen, this is the Doomsday Formula right here. This is the formula that reasonable people looking at reasonable data sat down and said, this is the way in which we want to set up our gearing. We want to set it up, and I didn't do any numbers here, but you can do them in your head, that if you're thinking business loans at 100 weighting and mortgages at 50, and now you drop it down, you leave mortgage loans up, business loans up at 100, and you drop down mortgages to 17, what do you think that does to the gearing, to the overall leverage that you're under in the system?